Welcome to Global Insights 24, simple tech answers you can trust. If you're looking for clear explanations, quick tips, and just a bit of fun along the way, you're in the right place. Let's dive in.
Solvency in accounting is a key concept that shows how well a business can meet its long-term financial obligations. It is different from liquidity, which deals with short-term cash flow and immediate payments. Solvency focuses on a company's ability to survive over time by comparing what it owns to what it owes. A solvent company is one that has enough assets to cover all its liabilities, both current and future. Accountants and investors use solvency to understand whether a business can continue operating without financial distress. The most common way to measure solvency is through ratios that analyze the relationship between total assets, total liabilities, and equity. One important ratio is the debt-to-equity ratio, which reveals how much of the company's funding comes from debt compared to owner's investment. A lower ratio generally shows stronger solvency, meaning the company relies less on borrowed money. Another helpful measure is the equity ratio, which compares shareholders' equity to total assets. A higher equity ratio indicates that the company is financing its operations more through its own funds rather than debt. The interest coverage ratio is also used to assess solvency, as it shows how easily a company can pay interest expenses from its earnings before interest and taxes. Strong solvency means the business can handle downturns, repay long-term loans, and invest in growth opportunities without risking collapse. Poor solvency, on the other hand, signals that a company may struggle to meet its debts and could face insolvency or bankruptcy if conditions worsen. Maintaining solvency requires careful financial planning, stable revenue streams, and controlled borrowing. Accountants often review solvency ratios regularly to identify risks early and make adjustments before major problems occur. Investors and lenders also look at solvency when deciding whether to invest in or lend to a company, because it reflects long-term stability and reliability. In summary, solvency is about financial strength over the long run, ensuring that a business can meet all obligations and continue operations. It is vital for sustainable growth and confidence among stakeholders. Understanding and monitoring solvency helps management make wiser financial decisions and build a stronger future. Thank you for watching, and don't forget to like, share, and subscribe for more accounting insights.